Friends, welcome back. Let us continue our discussion on capital structure theories. Going to share my screen with you. By this time, we have learned several theories. And the next theory that we are going to learn is called as theory. And stands for Modigliani and Milos. This is Modigliani and Milos theory. So, this theory believes that the capital structure has got no relevance on the value of the firm. That means value of the firm is not going to change because of capital structure. Okay. That means a firm which is having a more debt and another fine, almost another firm, let us say almost everything is similar, but capital structure is different. That will not command a different value. So the two firms are not going to command different value just because their capital structures are different. Okay, so that is what this theory says. And the theory believes on this concept that the value of the cake will not change if you cut it into two pieces. The cake as a cake has got a value, but whether you got two pieces or four pieces, that doesn't matter. That means whether it is an all equity firm or there is a debt and equity in the capital structure, that is not going to affect the value. Okay. The earlier also, we have seen some other theories. Okay, we have already seen net income theory, the net operating income theory. Net operating income theory was also talking about the same thing, that the value of the firm will not change because of capital structure. Approach is also saying same thing, but by using a different logic. This theory says that the capital structure will not change because of principle of arbitrage. Principle of arbitrage means, what does it mean? This is a theory of economics. This theory is a same product cannot have two different prices in two different markets. Okay, suppose there is a product, two different markets, it should not have two different prices. Okay, assuming that there is no transportation cost, no taxes, and all these assumptions. Why it is so? Because the theory believes that if the same product is sold at different market at different prices, people will buy from the market where it is cheap for us, and they will be selling that product in the market where there is dearer. That means they'll buy from a cheap place and sell it as a costly place. So this process will continue. As a result, what will happen? Over a period of time, price will stabilize. That means price will remain same. Because where they're buying, there will be buying pressure. Buying pressure will increase the price. When they're trying to sell, there will be a selling pressure. Selling pressure will reduce the price. So price will come to an equilibrium in long run. So there might be some price differences for a temporary period, but over a long run, these price differences will not be there. That will be leveled out. So theory believes the same concept. And it says that farm cannot have two different values just because capital structure is different. Okay, because if at all they command two different values, investors will move out from the farm where there is a high value. They'll be selling that security so that they'll get more price. And they'll move into the company where the value is low. Okay, they'll sell the costly securities and buy the cheap securities because securities are more or less same, farmers same. So in this process, they'll be gaining, they'll earn profit, they'll sell at a higher price, buy at a lower price. And this process of buying and selling will go on till the price reaches an equilibrium. That is what the theory suggests. But the theory has got so many assumptions. First of all, first assumption is that farm can be classified according to same risk class. That means both the farm risks should be same. Then only investors will take this risk. Second assumption is that investors are rational. That means investors can logically think and take a decision. And the market is perfect. There is lot many buyers, lot many sellers. Okay. Then transactions are spontaneous and costless. There is no transaction cost. There will be free flow of transactions. There is no taxes. There is no barriers and information flows smoothly. And the earnings are distributed as dividend. All earnings are distributed as dividend. Shareholders will be able to create personal leverage. Personal leverage means they'll be able to borrow at the same proportion, at the same cost. That of company. Let us say company is borrowing at 9%, shareholders can borrow at 9%. Company has 10% debt in its capital structure. A shareholder can also maintain 10% debt in its capital structure. That, that means shareholders will be able to create personal leverage. Let us understand the theory with the help of this example. Look at this example here. There is a farm A and there is a farm B. Both the farms EBIT is 18,000, 18,000. But market price of share in one farm is 1 rupee, other price is 1.2 rupees. That means share price is cheaper in farm A and it is dearer in farm B. So a rational investor, what he should do, he should sell the shares of company B and buy the shares of company A. Okay, so that he can get a profit of 0.20. Farms are same, so business is same. Okay, so maybe farm B is overpriced, so he'll be selling it and buy farm A. We look at the capital structure. It says equity in farm A is 150. It's an all equity farm. Farm B contains equity 90,000 and debt 60,000. Total capital is also 150,000. The question is asking, please advise Mr. X, who holds 9,000 shares of face value B1 in farm B. Mr. X is holding 9,000 shares. What should he do? That is what the question is. Now you have seen that since he is holding in farm B, first of all, he should sell it. Let him earn some profit. And let him also create a personal leverage and borrow some money. Let us see what is his profit. Let us calculate that. So this is our advice. First, as per MM theory, Mr. X should sell his holding to company B. He was having holding in company B. He was having 9,000 shares. So entire 9,000 shares should be sold. Then he should borrow a loan at the rate of 6%. You may be thinking, why should he borrow? He is borrowing to create a personal leverage so that his profit can be maximum. He can create a personal leverage, so he should create it. And since company is borrowing at the rate of 6%, he should also borrow at the rate of 6%. Okay. By doing so, he will be in an advantageous position. Let us test it. If he will be in an advantageous position, everybody will follow that path. Everybody will earn some profit. And as a result, the price will be brought to an equilibrium. That means price differences will not be there. If the same companies where everything is same, but capital, because of capital structure or because of some reason, prices are different, people will sell where price is more and buy where price is less. So let us see what advantage Mr. X is getting. Step 1, his shareholding pattern we have understood is 10%. So he is going to sell his holding and borrow 10% of 60,000. Okay. Okay. Why he is borrowing 10% of 60,000? Let me show you the capital structure. Okay. In case of company, you see 60,000 debt is there and 90,000 equity is there. Mr. X is having 9,000 equity. So proportionately, he should borrow. So since his holding is 10%, he'll be creating a personal leverage. He should also borrow 6,000. So selling price, he'll be getting 9,000 into or share 1.20, 10,000, 800. He's borrowing 60,000 rupees at the rate of 10%. 6,000 rupees borrow. He's borrowing 6,000 rupees. That is 10% of 60,000. It comes to 16,800. So this much of money he's having. Now, by using that money, what he will do, he'll buy the shares of company A, where share price is P1 only. So totally he will be buying 16,800 shares. And with that, his holding will be 11.2%. He'll be holding 11.2%. Okay. Now, if you look at the EBIT of company A, his profit is 18,000. There is no interest payment. So this 18,000 is to be distributed to shareholders. Mr. X will get 11.2%. He is getting 2,016. That much of money he will be getting. But out of that money, he will be paying interest since he has borrowed 6,000 rupees at 6%. So 360 rupees will be paid. So net income of Mr. X will be from company B, sorry, for company A will be 1,656. Now, suppose Mr. X would have continued with company B. Let us say how much he would have earned. B's EBIT is again same 18,000. Company B will pay interest 3,600. Profit available for shareholders is 14,400. Mr. X share will be 10%. That is 1,450 you would have got. Now he is getting 1,656. So he is gaining by 260 by doing this activity, by selling the shares of company B and buying the shares of company A. Is a gainer. Everybody will follow that path. When everybody follows that path, what will happen? There will be a selling pressure in company B. Okay, everybody is selling that price. And there will be buying pressure in company A. When everybody will buy, the share price will go up. 1 rupee will slowly go up. And then there is selling price, then 1 rupee 20 paisa will slowly go down. So they will be brought to an equilibrium. That is what this theory says. Okay. Friends, I think you have understood. With this, we cover all the capital structure theories. Thank you very much.